between direct costs and indirect costs. In direct costs, we say these are the costs that are directly attributable to units or the production that we are making. Indirect costs are indirect expenses that we are incurring in making something. So, for example, examples of indirect costs, they include um, uh, the electricity bill of the marketing department. Marketing department. Yes, I can. Acha ji. So for I was saying, 1 second. How do you do that? Your screen window. This one. Acha ji. So for indirect costs, for example, the departments which aren't directly involved in production, finance department, legal department, sales department, marketing department, the costs, the salaries that we are paying to workers in these departments, to employees. These employees, they aren't directly involved in production of things, yet they're essential to working of the organization. So these indirect costs, they would be called overheads. Okay. Similarly, for production, sometimes we are using a material. Let's say that we are making bats, and in the process, in order to lubricate the machinery, we are using some grease. Can I say that bat is made of grease, cricket bat? I can't. Yet, grease is a material which was used to manufacture this cricket bat. So this is how this is another example of indirect material being used. And these indirect expenses, I refer to them as overheads. They can take the form of electricity cost, they can take the form of rent, they can take the form of insurance, and other examples as well. Acha. Another concept that we have to study besides the two liquidity and overheads, there is a thing called solvency and insolvency. What is solvency? And more importantly, what is insolvency? Solvency is the position of a business when the business is able to meet its liabilities. When a business can meet its liabilities, meet or pay. Okay. Similarly, if a business runs into a situation where it is unable to pay its liabilities, then the business is declared insolvent. In Urdu or Hindi, perhaps we use the term दिवालिया निकल जाना या दिवालिया हो जाना business का, right? So दिवालिया होना, what does that exactly mean? That the business, it is unable to pay off the liabilities that that it was responsible, that it was supposed to pay. अच्छा जी. So all of this when it is not happening, that is insolvency. Acha, the next thing that we have to understand is that we have understood that there is a format on which we have to prepare. I mean, for everything, for the financial statements that we have, uh, okay, for the financial records that we have, there are two types. One that is required by law to be maintained, and the other type of financial statements or financial records are the ones that we are preparing just for the internal reporting purposes of the businesses, just for our internal calculations. Not everything is mandated by law. We need to do our own calculations, our own assessments besides the law as well, right? So whatever the legal financial statements they are required to be prepared, usually the law also suggests a format for that, that they have to be prepared on this format. As for the things that we are preparing just for the internal use of the business, uh, then it's up to the business that whatever format that they prepare those statements on. Is this thing clear? So for all these things, for statement of financial position, for income statements, for cash flow, there is a legally prescribed way that you'd study in your, if you study the subject of accounting. For now, what we'll study is that what's the format on which businesses they usually prepare their cash flow. One thing. The other thing, between the statutory records, that's the legal requirement of records that you have to maintain, and the management records, the difference is that law usually asks you to report on what has already happened. So, for example, only after you finish an accounting year, you will be asked to prepare the statement of financial position, and you only after you have earned and finished that period, you can report your profits or losses. Right before that, it will just be a projection. And obviously, in most cases, businesses they'd like to over project in order to make the stakeholders happy. They'd like to state that they'll earn a lot of profits, that their assets will swell and everything. They'd like to present a positive picture of the business. Make sense? So, what we are concerned over here with is that that is why usually that the statutory records they are on financial accounting, and accounting is on the past information, and the management records of the business they usually concerned with when we are doing planning for the business. Whatever has been earned, whatever my assets have been, whatever my cash flow has been, that doesn't concern me. Now I'm planning for the future, so I want to see what the future would look like. Okay, and in that aspect, one document for the cash flow that I prepare is something called cash flow forecast. So cash flow forecast is simply predicting what the cash flow position of the business would be in future. And this format that we have studied, cash inflow minus cash outflow, that's net cash flow plus opening cash, that's your closing cash. This is the format that we use for internal records. For the statutory requirements, the format of cash flow is different, and we are not studying that right now. Okay. Okay, so let's say now this cash flow, how often will it be prepared? It would also vary from business to business. A business, they might want to prepare their cash flow forecasting for every week. Another one might want to do it for every month. Another one might want to do it for just every quarter. So again, it varies from business to business. Since this it's their internal reporting matter, so it's up to them to choose the frequency of reporting. Okay, let's say a business is preparing these cash flow forecasts month to month. Okay, so I'm writing over here the months. First I'll have Jan, then I'll have Feb, then I'll have March. Okay, so the business first they'll say what's the cash inflow that we expect in this month. What are the things that will create cash inflow for the business? Yes, sir. What are the items that can create cash inflow for the business? So when we make cash sales, when we sell something and people they pay me upfront for that, so cash sales, that is one item. Any other thing? Very good. No, not when they take loan from me, when they pay me back loan, or when my debtors pay me. Somebody to whom I've sold the goods on credit and they have now returned that amount. So whatever they owed me, they have now paid that amount. So payment from debtors, payment from debtors. This will also create cash inflow. What else? If you take a bank loan, so if you borrow money from someone, yes, it will create a liability for you, but it will also result in cash inflow for your business, right? Acha ji, what else? If you sell any of your assets, so, for example, we studied that for internal financing that a business can generate, one of the possibilities is that they sell one of their existing assets, or if an asset has reached its useful life and now it's no longer being used in production or for whatever purpose it was initially bought, it's just lying around vacant, so idle. So it's better to sell it. So if you sell any asset, that will also generate cash inflow for the business. Okay, and here we are writing actual money that is coming into the bank account or in cash form to the business. All these items they'll create cash inflow for the business. What will create cash outflow? So from this cash inflow we have to deduct cash outflow. So right over here, less cash outflow. What will create cash outflow for the business? So we'll perhaps look at things in the same order as we looked at for the inflow. So the first thing, if we are making cash purchases, if we have any cash purchase, that would result in a cash outflow. Similarly, paying off our creditors. If we bought something from someone and passed on credit and we told them that we'll pay you on a later date, so payment to creditors, payment to creditors. What else would result in cash outflow? For example, if I pay back any loan, repayment of loan. When I take loan, I'll have cash inflow. When I repay a loan, there will be cash outflow. Repayment of loan, that will result in cash outflow. And one other thing, if I purchase any asset, cash purchases it could have been covered over there, but purchases we usually talk about inventory. So now we are talking about an asset. So cash purchase of asset or payment, any outstanding payment, all the payments they'll result in cash outflow. Or payment of expenses, for example, salaries, payment of overheads, I'm writing in general, would cover all the expenses, the utility bills, the salaries that we are paying, etc. Okay, all these things they'll result in cash outflow. So once I've got cash outflow, just a second, uh, these two they'd give me the net cash flow. Asha ji, if I have this sum over here and from this I deduct the all these things, then this will give me net cash flow. And in net cash flow, I said that I'll add the opening cash. Let's say the person just started with the started business, he wouldn't have any cash, but I'll just write over here opening cash for the reason I'm about to tell you. And then if I add opening cash to it, then I will get closing cash, right? 1 month's closing cash would be next month's opening cash. Hmm. Okay. So that is how we forecast things that we see. This is the cash that we'll generate. And what's the cash that we would be left with at the end of next period depends on what's the cash we had at start of the period. Okay. So it goes on and on. So preparing these financial statements, preparing these forecasts, they help a business know that, okay, let's discuss this now. So this is the format that we'll prepare the cash flow forecast on. The question now before us is, what's the benefit? What's the benefit of preparing cash flow forecasts? Yes, sir. What do you think? The employees. So first of all, the very basic thing that we said, it would it would reduce the chances of business failure, because one chance for, especially for small businesses as well as for at times for large businesses, the thing is that no matter how profitable you are, if you don't have cash, you'll fail. Okay. And how would you know that you'd have enough cash or not? If you do prior forecasting and then you match actual results with that, that is something that will help you prevent the chances of failure. Similarly, uh, reduce business failures, it would automatically imply that I am able to make payments on time, make payments on time, or in other words, have sufficient cash for payment when needed. Have sufficient cash for payment when needed. Why, sir? Because if I am planning to carry out a cash outflow, let's say in the month of Feb, okay, so I am saying that there is going to be some cash outflow over here. Let's say I'm going to make some massive asset purchase. That would tell me that how would that leave me with the net cash flow position, and how would that leave me with the closing cash position. Would that result in negative closing cash balance, or if it's, for example, showing me that because of this particular negative outflow, I'm ending up with a negative cash balance over here, it means this thing is necessary. Either if I postpone it, I change timing of it so that the cash flow doesn't become negative, net closing cash it doesn't become negative, or the other option is that I have sufficient opening cash so that this thing is financed. In order to have sufficient opening cash, I'll see either I'll have to reduce the cash outflows from the previous period, or I'll have to increase the cash inflows from the previous period, right? Was it too much? Shall I re-explain what I just said, or did you understand the scenario? Okay, okay. So what I'm saying is that in the month of Feb, you are planning some cash outflow. You want to purchase some machinery, which would involve a lot of cash outflow in the month of Feb. So just a second, let me draw lines and separate. Okay, so this is your month of Jan. This is your month of Feb. In Feb, you are planning some cash outflow. You want to make some major purchases of assets in, or you want to make some major payments for purchase of asset. If you put this figure in here and you do the calculation, you add the opening cash, it turns out that the closing cash for the month of Feb, it's no, this closing cash, yes, it would be the opening cash for March, but this is turning out to be a negative figure. It means we are going to spend more than what we have. It could be a bank overdraft. So it shows that we are running into a position where we do not have enough cash. So what's the method to reduce this closing cash negative position? I will have to either postpone this expense to some, or there is no, not for March. I'm right now planning for Feb. So either I option number one, postpone this expense, do not carry it out. But at some point I will have to carry it out, and let's say that the payment is as per some agreement, and it has to be carried out in Feb. I cannot postpone it. Then the other options that I have is that either I increase the cash inflow in the month of Feb. If I increase the cash inflow, that would mean this negative closing cash that I had, the situation would disappear. It could disappear, right? The third option is, so the first option was postpone, and we are saying this is not an option really. The second option is increase the cash inflow, so that from this increased cash inflow, I'm able to fund this cash outflow. The third option is, let's say cash inflow is also, we are unable to increase it. The third option is that I have a strong opening cash for the month of Feb, so that I'm able to make this payment from this. If I've got big opening cash, then that would also mean that my cash flow, negative cash flow, it can be averted the situation. I can still end up with a positive cash flow, right? So in order, let's say that option two is also not available. So that would mean that I need to have a strong opening cash, which means I need to have a strong closing cash for the last month. And again, for the strong opening, for the strong closing cash of the last month, what I'll have to do is either I will have to reduce my expenses, or I'll have to increase my, not expenses, I'll have to reduce my cash outflows, or I'll have to increase my cash inflows for the last month. So for the last month, if my cash inflows increase and my cash outflows decrease, my closing cash would increase, which would mean for the next month, my opening cash is increased. And from this, I'll be able to fund this. So all this I will be able to plan only when I have all these future projections and forecasts of when the cash is inflowing into the business and when the cash is outflowing from the business. Another thing, another thing, having too much cash surplus is also bad. So for any month it looks like that you are having too much closing cash and it's increasing. It's also not good for the business. It means that the business, it is keeping its assets in the form of cash, whereas simply keeping them in the form of cash doesn't earn you much money. The maximum you'll be able to earn it would be some savings account return on it. That's the maximum. That even the savings account return, they block the cash for some time. The point is, if you have got too much cash lying around, it means you aren't planning your cash flows properly, and it means that you aren't investing your cash properly. You are acting too risk averse. So maybe you should invest in more opportunity. Either you are acting too risk averse, or you are not planning your cash flows properly, or there is managerial lack of oversight. But there is some problem: too little cash and too much cash. We don't want to end up in either of the two situations. Okay. Acha. Another thing, this closing cash, how much of your assets should you keep in the liquid form? It also varies from business to business. It also varies from industry to industry. For different industry, there are different norms of how much of your current assets they should be in liquid form. So, for example, for banks, it could be very high. For some other industry, it could be very low. Okay. So again, this is something that varies from business to business. Sorry, industry to industry, business industry to business industry. Achha, let me see. Closing cash balance. I've told you how closing of 1 month would be opening for next month. Uh, okay. So we were discussing the benefits of forecasting. One, we said it reduces the chance of business failure. It enables us to make payments on time. It also helps us identify cash shortages and cash surpluses. Identifying cash shortage slash surplus before it actually occurs. ठीक है जी. अच्छा, it would also enable us to identify. It helps us identifying when to allow slash disallow credit to customers. So when are you in a position that these are the months that you are already foreseeing that you would be having surplus cash? So maybe you can be lenient with your customers, allow them more credit in order to gain business. And similarly, you can foresee the months in which you would be running tight on cash. So these are the months that you'll have to make sure that the payments they arrive on time. Achha, the same way it applies to customers, it also applies on identifying when to ask for uh, credit from your suppliers. So the same way you are allowing your customers or not allowing your customers credit based on how much cash you have, you'll also foresee months, for example, some months in which you are running tight on cash, you'd ask your creditors to perhaps offer you some lenient credit terms, because you're running low on cash. So you'll ask them if they can reschedule your debt payments, or they can reschedule your payments or defer them a bit. So you pass through this time, and then in the next periods you'll have more cash which would allow you to make their payments. Okay. When to ask for credit? Acha, it could be for when to ask for credit, or it could also be when to ask for loan. When are the times that could perhaps, for example, you are going to make some massive purchases, and in that period of time, you'd perhaps need to take some loan. If you know this beforehand, you will be able to negotiate the terms of the loan beforehand and perhaps get a better deal, as opposed to when you get to the financier right when you need the loan, and then they sense your urgency of seeking the loan, and perhaps they charge you a higher interest rate. So for example, you foresee that in the month of March you'd be running low on cash. Okay, and that is the time you would perhaps need to borrow some money. Are you following me? Okay, so if in Jan I start negotiating the term that in March I'll take a loan from this bank or whoever the financier is, then the chances are that I get a better interest rate, as opposed to when the month of March arrives and right today or the next day I need cash, and then I go up to them and ask for loan. I might not be able to get that better a deal, the one that I could have got had I asked for this earlier. So another thing this cash flow forecasting helps us, it helps us identify where the money is being spent. Excellent, excellent. So what are the activities that are taking away a lot of cash, and what are the activities that are generating more cash for you? Which activities should generate more cash? Which activities should where the money is being spent slash coming in from? So you are able to monitor and alter your activities accordingly. Acha ji, that's pretty much it for this chapter. Any question this far? The whole chapter. I'll give you a recap for this. How about we do the MCQs for this right now, page 223 of your book? If you could please give me answers. Cash sales, excellent. Question 2. Payment for raw materials, excellent. 24,200. Yes, insolvent, excellent. Ashaji, let's write down, describe what a cash flow forecast shows. Three marks. Ashaji, for question 2, 9 months, use a spreadsheet if possible for them. You'll have to 9 months. So let's say this is a 10 marks, 1 mark, 1 mark for the format, and 9 marks for 1 mark for each month. Since you're doing it for the first time, let's make it a 10 marker. Maybe on your exams it would be. Acha, during the 9 months period, let's say this is a 5 marker. I'll have to see. I haven't seen the cash flow position, so I'm just giving an arbitrary number right now. It might be comment on the cash. I'll tell you for this sort of information how much could marks could it be asked for once I actually see the question and your answer. Business early 2016, 3 marks. ठीक है जी. We meet again on